Hi everyone, good evening. Welcome back to our LLF Let's Learn Futures webinar series. How are you doing today? Good. I hope you are doing well and fine. So today's topic is about be familiar with Malaysia futures and the options market. This LLF webinar series is brought to you by Bursa Malaysia and in collaboration with our company Excellent. This webinar will be starting from 8:30 to 10. My name is CY Song. I will be your moderator for this session. Today, we will be having David Ng. He will be sharing with you an informative topic about Malaysia futures and options market. And now, I believe many of you here are probably still very new, or maybe you're not familiar with the Malaysia futures market because you're so used with the stock market, right? So this is what today's topic all about. David is going to share with you more about the futures as well as the option market in Malaysia. Before we begin, just a final check. If you can hear me, type in OK or yes in the chat box, or give us a thumbs up so that I know you are able to hear from your side. You can also adjust your volume so that it is audible and you can listen to my voice clearly. Are you ready? So let's get started. Now, depending on whichever area that you are currently in right now, some of you might be experiencing internet connectivity slowdown, or if you're using mobile internet, it may not be stable. So to ensure you can enjoy the smoothest and highest quality video possible, please turn off your video camera so you can enjoy a smooth video and have a good learning experience, okay? Our session for today will be divided into two sessions. The first hour will be presented by David. Then we will be opening up for Q&A session. So if you have any questions along the way, you can type in your question in the Q&A box, okay, so that you know immediately what are the things that you would like to ask or clarify with. And later on, we will answer your question later during the Q&A session. And remember to type in your question in the Q&A box. And make sure it is sent to all co-hosts so that I can directly grab your question in the Q&A box. Because there may be a lot of conversations in the chat box later, and I may not be seeing your question in the chat box. As this LLF Let's Learn Futures webinar series is brought to you by Bursa Malaysia, we have several interesting upcoming topics and more to come. So each and every Tuesday, we will be having this LLF webinar. We will be having topics that will be conducted in three languages, English, Malay, and Mandarin. So if you are just only trading the stock market or just started trading the Malaysia futures market, whether is it FKLI or even FCPO, or even if you are currently interested in adding futures into your portfolio. So this LLF webinar is definitely right for you, where our panel of speakers will be sharing with you insightful knowledge and practical strategies related to futures trading. There are still more content packed and informative topics lining up, and we will be adding to our list accordingly. So if you're interested in any topics and want to improve your knowledge and skills on futures trading, you can scan this QR code and register yourself and make sure add into your calendar so you don't miss any of these sessions. Besides the LLF webinar series, we also have the LLF online workshop. Now, this online workshop is a little bit different from the usual webinar because this LLF online workshop for those who are serious in getting started in futures trading. In these workshops, we will be covering a full set of beginner's knowledge in futures trading and that are important and essential for you. So it will be a step-by-step guide process to enable you to kickstart your first futures contract. So each session will be around 3 hours. So if you're new in futures trading or would like to learn how to trade futures, quickly register yourself in this online workshop. It's entirely free and it's fully sponsored by Bursa Malaysia. Okay, and most importantly, this is only limited to the first 50 online attendees only. So quickly register yourself and grab your seat fast, because this workshop is right for you if you want to kickstart your futures trading. And the upcoming session is this coming Saturday. So quickly register yourself in this. Now, before we begin, let me introduce our speaker for today. He is David Ng. He has extensive experience in the derivative industry. Formerly, David was the head of marketing in Philip Futures, leading the marketing team in growing the derivative industry. Currently, David is a full-time proprietary trader with Iceberg X, Sendirian Berhad, which is a local proprietary trading firm in the local futures market. So what that means is that David really trades a lot. So without further ado, let me pass the presentation to David.
Thank you for a very kind introduction. Firstly, just before I start, just like to thank Excellent as well as Bursa Malaysia for organizing this webinar entitled "Be Familiar with Malaysia Futures and Options Market." Now, I think it's probably some of the audience here, you're new to the Malaysia derivative scene. Obviously, if you have been traded before, or even you have heard over the media, there's always the two major product that's heavily traded in the derivative market, which is the crude palm oil market as well as the FTSE KLCI index futures market. So these two products are the major products being traded across the board, and we have a lot of audience and traders that's actually participating in the market. Now, just before I start, as usual, risk disclaimer. I think any materials presented here is purely for educational purpose. So recommendations or solicitation of any advisors, please do consult your respective licensed advisor or professionals. Dabbling with derivatives does involve a lot of risk, so make sure you have proper and suit yourself with proper education, and do consult with the licensed representative. And keep in mind, I think materials here are purely based on educational purpose. Examples given are purely based on education as well. So just take it as a theoretical aspect. However, when it comes to reality, it will be a slightly different scenario. But the key thing is that at the end of the webinar, hopefully the audience can able to grasp a basic understanding on how to apply futures, be it whether you are trading the market or be it you want to taking just a speculative position. So in the next hour or so, basically I'm just going to give you a very basic introduction to the Malaysia derivatives market, basically the futures market per se. And being as a trader trading the market full time, most of the traders in general aspect, they start off as a technical trader. Technical trader in the sense that they look at charts to determine the buying and entry signals and whatnot. Obviously, I think in this day and age, being a pure technical trader doesn't always be the case. It's always good to incorporate certain aspect of fundamental as well. So I'm just going to dabble a bit of fundamental as well as technical, and basically highlighting some simple trading setups that you can use. So you're new to the market, probably this is something that you can look at and start off with, and start your journey in the futures market. I also will be touching on the second part of the webinar, touching on the options market. It's a bit underrepresented, but options is a very good instrument in a way to hedge your risk, and also to minimize exposure to a certain extent. So I'll be covering that on the second part of the webinar. Now, I think being many years in this industry, especially in the futures industry, I always get this question a lot. Is dabbling in the futures market very risky and dangerous? Now, I just like to point you this analogy. Now, what I show you here is basically two pictures of two different cars, two different vehicles. If I were to ask you, I give you a choice, which particular vehicle will you be rather to ride in that you think is safer? Is it A or is it B? I just want to get your feedback from the audience. Maybe you can just type your responses in the chat box, and from there probably I could gauge which particular aspect you think is a safer ride, A or B. Yeah, I see a lot of responses coming in as A. Just for the audience benefit, A is basically is a Hummer. It's a very tough vehicle. B is basically it's one of the smallest vehicle in the world. It's called P50. I think it's only available in the European market. Now, the reason I point to use this analogy is simple. The question asks, obviously, if you look at it, relatively speaking, A is obviously more safer as compared to B. Now, in reality, when it comes to financial instrument, it doesn't matter which vehicle you are in. Ultimately, it's the driver that is making the decision. So regardless whether you are in vehicle A, doesn't mean that you won't be prone to accidents, or you won't, and when you involve in accident, you won't get injured. So same goes for financial instrument. Regardless what type of instruments you are in, whether it's a futures market, or whether it's in the equities market or in the commodity space, ultimately the main decider is still you yourself. So really, I think it depends on how you navigate using that instrument. So if you ask me, is futures risky? Well, it depends on how you're going to use it. You know, any instrument that if you use it without proper risk measurement, without proper risk control, without analyzing, the mental psychology when it comes to aspect of financial aspect, ultimately it will still be a risky instrument. I think that's the main thing that when it comes to the aspect of determining whether futures is risky. So I think in all, it really depends on how you're going to use it. Ultimately, futures or options market is just an instrument for you to use to gain exposure in the market, but eventually you are the one who make the decision. So, importantly in trading or be in investing world, it's always matter on managing your risk. That is always key. Now, so just jumping into the basic introduction to futures market. So if you just look at the proper definition, you can get it on Wikipedia. Basically, futures market is basically a contract. So every time when you refer to futures, we always refer to it as a contract. What we are trading ultimately is like a contract, a piece of paper. So what these futures basically means is that it's a standardized contract, with predetermined future date, for predetermined price, and at the end of the day, there's always an expiry on the particular contract for the futures contract in per se. So take for example, there's the palm oil contract. So its palm oil contract is always fixed in a certain amount of quantity for each contract. There's always a fixed grade. There's always certain grade that they have to meet, whether it's from the buyer or from the seller perspective. And there's always a predetermined expiry. Same goes for the FTSE KLCI index futures. There's always a predetermined expiry as well. So basically, I think futures contract is ultimately, keeping in mind, it's always a contract that's traded on the market. It's a contract between both parties, and it's always based on certain standardized product, whether it's CPO, whether it's KLCI index futures, or whether it's other commodities like corn, wheat, or whichever. So the benefits of futures contract itself. I think the main source of it is basically a contract between two parties, and that's ultimately what you've been trading in the market. So these are some of the key features of a futures contract. So in that contract, it states that every quality and quantity are all fixed. I think that's one of the benefit of using futures. So if you are, let's say you are doing you are planning to buy a certain commodity, let's say CPO, there's always a fixed quantity and fixed quality for every single contract. So there's no risk of afraid that a particular contract may be different from another contract, because every contract it is same and it's traded on the exchange. So in a sense, I give you a bit of assurance, and therefore I think futures market itself is very vibrant because of this kind of key features that's available on each of the contract. Obviously, every futures contract comes with expiry, be it whether it's a commodities contract, futures contract, or whether it's an indices futures contract. So say for example, CPO expires on the 15th business day of every month. KLCI index futures expires on the last business day of the month. So expiry is an important feature when you are trading the futures market. Now, expiry settlement is also very critical features of the futures contract. So there's always two types of settlement. One is a physical settlement, or one is a cash settlement. Now, physical settlement, it means that, for example, if I were to go into a palm oil contract, it allows me to buy each contract 25 metric ton of CPO, which is deliverable. So at the end of the day, if I decided to hold this contract until the 15th day of the business month, which is the expiry day, that means I'm actually engaging into a physical settlement. That means if I'm a buyer, I'll be taking a delivery of 25 metric ton. Now that's a big problem. If you're someone that's not in a business of doing palm oil, if you are purely a speculator, just participating in the price movement, expecting a 25 metric ton coming to your doorstep is a lot. It's technically a full tank. So that's where physical settlement comes into play. Now, cash settlements is the other way around. Cash settlements is easier. So say, for example, the index futures, the KSI index futures is technically a cash settle contract. So when it comes to the last business day of the month, which is the expiry day of the month, you don't get the top 30 counters. Technically, they settle the price difference between what you enter and what you exit, and they just rebate you basically on your profit and losses. So cash settle contracts are easier to manage when it comes to expiry, when it comes to settlement, as compared to physical settlement. So very important. If you are someone new to the market, if you are trading a palm oil market, do take note that when is the expiry day of the particular contract, because you don't want to be holding a particular contract when it comes too close to the expiry, and that's where your broker will start calling you and say, look, Mr. So and so, you are holding a certain amount of futures contract on the palm oil market, which requires you to exercise it, and that means you'll be taking a delivery, and you don't want to be having full trucks of tanks coming into your doorstep. I think that's that's an important thing, that if you are new to the market, be very sure that what kind of settlement that you are in. But I think nowadays, brokers are very friendly. The local brokers, they'll be kind enough to tell you if you are having a position in a contract that's too near to the expiry, they probably will ask you to close it out before the tender period, and that will avoid a lot of confusion or a lot of settlement issues going forward. So do keep in mind, I think expiry mode, whether it's cash settled or physically settled, is an important feature in the futures market. Now, the fourth thing is margins. Whenever we trade futures market, we always refer to margins. We don't say that you put a deposit. It's sort of a sense that putting like a fixed deposit to a certain contract. So, for example, if you want to trade the CPO contract, the margins right now for per contract of CPO is about 11,000 ringgit. So if you want to trade one lot of CPO contract, you need to have a margin of 11,000 ringgit in your broker's account. And obviously, if you want to multiply it, you want to trade 2 contracts, you need a multiple of 22,000. 3 contracts, you need a multiple of 33,000. So that's how margin works. And anytime this margin falls below the required margin by the exchange, technically you are being called a margin call scenario. Usually, the brokers will normally call you. They always will ask you whether you top up the margin or whether you liquidate your contract. So importantly, when you trade the futures market, always make sure that you have sufficient margin in your broker's account. Every time when that balances fall below the required margin by the exchange, you technically will be called by the broker for margin call. Now, margin call is something that every trader will trade off. We don't like picking up calls, especially from brokers, with regards to margin, but it's important. Normally, when you receive a margin call, that means your position is against you, and that's also it does have a bit of psychology impact. But technically, market is telling you just to be out of the market, because market is definitely at that point in time is against your position. So margin is important, and margin call is a important features whenever you trade the futures market. Now, fifth thing is about mark to market. So every day after the end of the trading day, all your positions will be marked to the current price, or the settlement price, as what we call it, to calculate your profit and loss. So there'll be no issue if you close your contract. But if let's say you have an open position in the market, let's say you're holding one lot long palm oil contract, and you decided to hold it overnight, which means you planning to hold it and for the next couple of days. Every day there will be statements issuing by the brokers to you, stating that what's your profit and loss at that point in time, at that day point in time. There'll be a settlement price that'll be issued by the exchange, and they'll calculate based on that. The reason futures mark to market, because it's a marginable product, it's important for brokers to make sure that you have the sufficient margin in your respective account after accounting for daily settlement. So once your margin is insufficient, therefore margin call arises. So technically, I think this is an important feature in the futures market, mark to market. So every day your positions will be just marked to the settlement price that's determined by the exchange. And last but not least, tick value is important. So every contract, regardless the product that's different, will have different type of value for tick value. Say for example, if the minimum tick value for palm oil, which is 1 point, is 25 ringgit. FKOI, half a point is 25 ringgit. So 1 point is 50 ringgit. So that's how we normally base the tick value is. So different product will have different characteristics and different tick value. So if you're new to the market, importantly for you to make sure that what is the tick value, the minimum tick value per se. So if you're trading a palm oil market, always understand that 1 point movement in the palm oil price is always equivalent to 25 ringgit to your P&L. So just to dabble a bit on the contract specification. Now SCPO contract, you can get this on Bursa Malaysia website. They have a comprehensive list of the contract specification. I'm not going to go too deep on the limits, the price limits and whatnot, because importantly, you need to know is, always remember, one contract is equivalent of a 25 metric ton. Technically, it's a full big tanker. So make sure if you are trading CPO, it's a physically settled contract. Make sure before the tender period, make sure you're out of a particular month contract, because you don't want to be engaging into a tender process, and that's going to be very messy. Trading hours is also slightly different for both palm oil as well as the KLCI index futures. For palm oil, it starts a bit late from 10:30 to 12:30 for the first session in the morning, and you resume 2:30 to 6 p.m. And obviously, I think just a couple of months, Bursa Malaysia Derivatives actually launched a T+1 session, which means the night session trading, which starts from 9 to 11:30 p.m. at night. So that's the trading hour for palm oil market. And I think pricing both for the SCPO as well as the KLCI index futures are priced in ringgit. Price limits. Now this is slightly important when it comes to when you see wild swings in price, daily price movement. That's where exchange will set basically movement in their price. So anything that's moving above 10% per day, in terms of the price movement, normally you hit the exchange price limit, and normally this price limits mechanism will kick in, and market will probably sustain a temporary freeze and will resume trading thereafter. So price limits are basically just for you to be aware, especially when it comes to volatile market or volatile market situations like this. That's where it becomes important to understand. But once other than that, I think it's just important for you to take note of. Minimum price fluctuation is 1 ringgit. So every movement is based on 1 ringgit movement, and every 1 ringgit movement is equal to 25 ringgit tick value. So settlement is always physical delivery. And the key thing is that there's also an options available on the futures market, which is going to cover later on. So do take note, the futures market do also have an options derivative on it. Basically, you also can use the options market in order for you to gain exposure in the palm oil market. Now, FKLI is also something similar. You look at a contract size, is every 1 tick movement or minimum tick value is 25 ringgit, so 1 point is 50 ringgit. Now, contract months that is listed is always the current month, the next month, and the next 2 quarterly months, calendar quarterly months, which is March, June, September, and December. So that's how the exchange put the listed contracts as it is. So later on, we're going to see how the listed contract is available. Now, trading hours are slightly different. Trading hours for KLCI usually starts earlier. It's around 8:45. So if you are familiar with the stocks market, normally stocks market starts at 9. So the futures market starts a bit earlier, 15 minutes earlier, in order for you to gain a bit of leverage. So for example, if something happened overnight in the US markets, there's no time for you to react when the stock market resumes, because there's a lot of news will be coming into the flow, especially when market opens. So one way is to actually gain the exposure in the futures market because it's open 15 minutes earlier. So that gives you a bit of window of opportunity. So do take note, the opening hours is 8:45 to 12:45 for the morning session. Again, if you notice that the trading hours for FKLI is slightly different from SCPO, is during the morning hours is actually trading 15 minutes later or close 15 minutes later than the CPO market. So if you are FKL trader, technically are working a bit harder in the morning session as compared to the palm oil traders. Afternoon session, same time, both the CPO market and FKL market resumes at 2:30. the only thing is that, since you started the day earlier, you ended the day even earlier. So the FKI ends at 5:15. Again, if you notice the differential, your stock market closed at 5, and the futures market will close 15 minutes later. So the futures market always open 15 minutes earlier and close 15 minutes later. So that's the trading hours. And right now, when we have the night market session, the T+1, which is also coincide with other the CPO market night session as well. It starts from 9 to 11:30. So it gives a bit of vibrancy, especially when you want to capitalize on certain movement, especially in the Western markets where at current previously our markets are not open. But right now, with the T+1 session in play, technically any movement in the US market, we could capitalize it on our futures market as well. So minimum price fluctuation is half an index point, is 0.5, and half an index point, the value of it is 25 ringgit. So every 1 index point movement in KLCI index futures, that will equivalent to 50 ringgit in terms of the tick value. So settlement is always a cash settle contract, so there's no concern of physically settle. Anyway, it's a stock index futures. It's not a physically settle by nature. But do take note that the trading day or the final trading day or the expiry of this contract is always the last business day of the month. So do take note of that. And you can get all these contract specifications from the Bursa Malaysia website. So going through this, basically, if you have a broker's platform, if you subscribe to a local broker, normally you can see the listed contracts for both the CPO as well as the FKI. So for FCPO, you look at it, it's listed at least throughout the whole next 3 years. So right now, if you have contracts that's trading up to May 2025, obviously, as we go further into forward months or further months, normally price is a bit hard to discover. Reason being is because there's a lot of uncertainty. We won't know what production is going to be. We won't know what supply or demand is going to be for the next 1 year or so. Anything can happen in between. But at least the good thing is that if you look at 1 year out, at least until end of next year, there's still at least contract that's traded. There's still price to be discovered. So this gives you a lot of opportunity, whether you are in the business, whether you are palm oil, mill, or you're a refiner. It gives you all opportunity for you to hedge your particular position, especially when you're far out of the month. So I think that's one of the key benefits of using a futures contract, because if you are someone that is having the commodity and you're not sure what price is going to be for at least the next 6 months, you don't have to worry. You just go to a futures market, you just look at the price of the next 6 months, and you can quote a particular price. So I think that's the wonderful thing about the futures market. If you look at FKI, it's also the same thing. So listed contracts is always the current month and the next month and the next 2 quarterly calendar months. So it'll be September, December, March, and June. So right now we have May, which is currently actively traded, and June, followed by September and December. Now, one thing I want to highlight, just going back to the previous slide, the CPO contract. If you notice that in terms of volume-wise, currently the July contract is traded the most actively. So when we refer active contract, we always refer to contract that's heavily traded in terms of volume. Now, there's a lot of reason why CPO always trades on the third month as an active contract. There's always a couple of reasons to it. It's also so-called historical convention since the market started. So I think every time when people say what's the benchmark contract for FCPO, we always refer to the third month in the listed contract, or rather you just look at it, the easiest way to differentiate, just look at the contract that's traded the highest volume. So right now, July is traded in a heavy volume, and that's where usually we refer to as the benchmark contract for the FCPO market. FKI, if you look at the heaviest traded volume, is always the current month, which is the May, and that's usually the benchmark month for the FKI market. So that's how you differentiate whenever you're looking into the futures market. If someone were to ask you what's a benchmark contract for a particular product, you can always refer to the contract months as having the highest volume traded on the particular listed contracts. So just touching a bit on benefits of trading futures market. So obviously, I think one of the key things is that futures market is highly flexible. Why I'm saying so is that flexible in a sense that you can always be long the market and you can always be shorting the market. Now, the concept of shorting the market is slightly unusual, especially in the Malaysia context, because the stock market only permits restricted short selling on certain counters. So if you want to go through the index, shorting the index favorite counters is a bit difficult. So one of the easiest way is actually to use a futures contract to do that. So in a sense, futures contract is highly flexible. It gives you an exposure on both ends. So for example, if you are thinking the market is going to go higher, you can always use the futures market to long a contract. In a way, it's also save you costs. You don't have to buy all the top 30 counters that's represented in KSI index. You can just buy the index futures for a particular margin. So that's in a way saving your cost as well and time. Second thing, I think if you believe that the market is going to face sluggishness, it's going to be weak, it's going to come down, you can always go to the futures market and short a particular contract. So I think that's in a way, futures market is highly flexible. You can go on both ends. You can go long and you can go short. Second thing, I think the key benefits of using futures market is highly leveraged. Now, leverage in a sense is a double-edged sword. Just to put a disclaimer here. Although it is beneficial for leverage, but whenever you are in winning situation, it looks good. But if you are losing situation when you have a high leverage, it will look bad on you. So for example, you look at futures market, everything is based on margin. When you don't have sufficient margin, there's always a margin call. And there's always a concept. When you buy stocks, you will be only losing your capital you put in for your particular stocks. In futures, it's not only a capital you put in. Sometimes you need to top up, and that's where there's no flaw in your particular capital requirements. And that's where leverage in a sense that you only come out a little bit of a margin for a full exposure. But when market go against you, it can go against you very badly. So that's where leverage is a double-edged sword. It can benefit you when times are good, but when market turns, when market is against you, it can against you in a very bad manner. So that's if you are someone new to the market, always make sure that when you are dabbling with futures market or even the derivatives market per se, make sure you have a proper stop loss in place or proper risk management that in part of your setup. Thirdly, low brokerage fees, because I think contracts, local brokers are charging you on a per contract basis. So that's not on a percentage basis. So in a way that it's cheaper in a sense as compared to the equities market. And rates now are also getting very competitively. So I think in a way, in a sense, that generally the brokerage fees are also coming down. So in other words, as a consumer of the futures market, in a way you're enjoying lower brokerage fees. Now, I get this a lot, especially when previously I was part of a broker. I always get this question, especially from audience that are new to the market, is that is Bursa Malaysia Derivatives has a lot of volume. Can you, whenever you enter a position, are you able to get out easily? The answer to the question, yes. If you just look at volume on an intraday basis or on daily basis, easily you look at CPO market, the benchmark contract is trading about 25 to 30,000 lots per day, and that's substantial. FQI is trading between 10 to 15,000. That's also substantial. And if you just look at bid and ask, it's always very thin. It's always one fraction of one tick. So there's no issue of having to come up with slippage or having to exit the market with heavy costs because it's a very liquid market. It's easy for you to be entering and exiting the market without incurring so much of a cost. So I think there's no issue about liquidity. I think the market is highly liquid enough. So just to give you a very simple calculation on how to use, how to calculate your P&L scenarios, given the market conditions that that you are trading in. So say for example in the palm market, let's say the current price is 6,000 ringgit per ton, value per tick is 25 ringgit, and maybe you have a view in the next few months or so, you decided to take a view that maybe the market is going to hit even higher because of fundamental and strong and whatnot. So you decided to take a long position. Now, obviously, in the next couple of days, or in fact, maybe this is just only a matter of minutes, the price went up to 6,010. That means, in other words, you have actually on paper you have gained 10 points, and technically on profit wise, you 10 times 25 per tick value, you have made a profit of 250 ringgit. That's on paper. And you decided to liquidate it, that's how much you'll be making. Keep in mind, these are all theoretical examples. We haven't include brokerage fees and whatnot. So theoretically, based on this example of a scenario, if you have longer market, you make 10 points. To calculate your profit, you just multiply it by 25, and 250 ringgit is what you make on the 10 points movement in the market. Now, if the market has turned otherwise, if you think that the market's going to go up, but market decided to turn the other way around and it went lower, so again, the same scenario, you probably take a long position at 6,000 ringgit. And too bad, the market, because of certain reasons, is decided to turn lower, and you lose 10 points. So this scenario, from a profitable scenario, went over to a loss scenario. So the way to calculate your loss, you take a 10 points movement, you multiply by 25, and you're losing 250 ringgit. So that's how you measure your profit and loss. And at the end of the day, if you decided to hold a particular contract, it's always marked to market. And that's where, they will calculate the base of the entry price against the settlement price that's determined by the exchange at the end of the day, in order to calculate your margin levels. So again, I think this is how some of the key benefits or key features whenever you're trading the futures market. Now, so volume wise, I think if you look at it, in fact, I think just last year or this year, first quarter, Bursa Malaysia Devs, I think, recorded the highest volume for SCPO, highest average daily volume. So you look at it, I think every quarterly, especially during this period where if you look at CPO market itself, we have actually surpassed all-time high. So it create a lot of trading interest, and it generates a lot of volume in that sense. So average daily volume, at least for the first half of this year, the first few months, we saw, especially in particular February month itself, where prices hit above 6,000 ringgit per ton. We saw volume actually, went as high as 60 to 70,000 contract on a daily basis. And look at open interest, which is open positions in the open market, regardless whether it's long or short, it's also increasing. That shows a healthy sign in the market. Participants are in the market, and there's a lot of trading interest. So there's no issue on liquidity. And if you look at FKY, it's also a similar picture as well. And I think SCPO market, this kind of level, this kind of price level, it just creates a lot of interest for different type of participants in the market to be using the futures market, whether it's to hedge or to speculate their positions. So that's pretty much on some of the key basic characteristics, features of the futures market. And I think all in all, you just need to know some of the key terminologies that is important whenever you are trading a futures market. And that will be very useful if you are someone that's new to the market to start off with. So now coming to early part, in the beginning, I did mention that, fundamental mixed with technical is sort of like, pretty much the play that a trader will use. No, you can't totally disregard fundamentals, because fundamentals ultimately will paint a long-term picture in terms of price. There's always a particular reason why price will always head up or head down, or be on a long-term uptrend or be on a long-term downtrend. There's always a fundamental aspect to it. Whether it's going to be lagging or leading, I think that's a different part of the story. But importantly, I think whether you are trading the market, it's important to have fundamental aspect whenever you're looking to a particular product. So these are some of the factors that affect CPO prices fundamentally. When it comes to commodities, you can't run away from basic economics 101, which means that whenever you have high supply, low demand, price it can't go up, it has to go down. Vice versa, if you have a situation where you have strong demand and low supply, prices will have to go up to adjust. So that's economics 101. Supply and demand dynamics is what determine ultimately your commodity price. So right now, you look at CPO prices, we are hitting all-time high. There's a lot of factors are pushing to why supply is getting limited. And eventually demand is strong because countries are coming out of the pandemic. That's spurring a lot of demand, but supply is just not there to meet. So therefore, prices will have to adjust. So supply and demand dynamics is always important whenever you look at any commodities market, not only limited to CPO. Now, if you are looking into CPO market, there's always a comparison between vegetable oils. The funny thing is that in vegetable oils, in palm oil always compete with other vegetable oil. Other vegetable oil, for example, like soybean oil, sunflower, rapeseed, these are all competing with palm oil for market share. Obviously, I think the champion right now is palm oil, because if you just look at sunflower, Ukraine is a very big producer. Now they are in conflict, so supply is undetermined. Rapeseed oil, some of the European countries are suffering from bad weather, and also logistical issue. So I think really palm oil is in a very sweet spot right now, in the world vegetable oil scene. So you know, other dynamics or fundamental dynamics of other vegetable oil is important to understand, because it ultimately will affect palm oil as well. So right now, as I mentioned earlier, sunflower and rapeseed, which is alternative product to palm, they are suffering from low supply. So eventually market will just have to look into palm. In fact, I think certain countries, they used to ban palm oil. Now they are starting to rethink that decision, because vegetable oil is just not sufficient enough to cater to that kind of demand. Now, energy prices is also an important factor in terms of determining CPO prices. The reason means because whenever you have high crude oil price, like when you have high WTI, normally we call it biofuel blenders. They normally will use palm oil to blend with crude oil in a way to save costs, and also in a way to reduce some of the vegetable oil supply. So whenever you have high energy prices, normally the biodiesel producers will like it, because that's where it gives them a lot of incentive to be in the market, to be buying more palm and blend it with crude oil. Government policies is important. In fact, it will affect prices. We just witnessed about 2 weeks ago when Indonesia decided to put an export ban in their own palm oil market. I think that really pushed palm oil price to as high as 7,000 ringgit. And because that ultimately Indonesia is the largest producer of palm oil market in the world, and if they decided to ban their export of palm oil, China and India, which is the largest buyer of palm oil, both Indonesia and Malaysia, they just have to look at Malaysia, because Indonesia decided not to export any of their palm oil out. So I think that's government policies will have an impact in terms of prices, and this, I would say, among the factors as listed here, government policy is one of the factors that's very hard to measure. The rest of it, you can sort of like forecast, or you sort of like can estimate. But when it comes to policies, or in fact even weather, these are the two important variables that's very difficult for us to predict or even estimate. So weather is again an important element. Malaysia is blessed enough. We have 2 types of weather only. The rest of other Western countries, there's 4 seasons, which is really make it very difficult for planting annual crop like palm. So I think Malaysia weather is in a way stable in that sense. But we always face a period of heavy rain and period of dry weather, and that's usually will have an impact on palm. So again, all this will have impact in terms of supply, and eventually will push up price as well. Geopolitical tension, needless to say, I think the Ukraine and Russia conflict is putting a lot of impact in terms of market, and I think that's again is going to be creating a lot of tension, especially in the vegetable oil space. And as a result, palm oil is benefiting from all this tension that is happening around the region. Now, just to show you, I think just to give you an insights as to why prices has been staying as it is for quite a long period of time, and why prices of CPO has been hitting all-time high again, is because I think for the past, since the start of COVID pandemic till now, we are facing sluggish production, and it has not growing since the early part of 2020. I think that's a major concern. If this trend were to continue, it goes to show that palm oil market is going to be in a very tight supply situation for at least another year or so. And I think prices will find it very difficult for it to hit to a certain level. In fact, I think prices will stay where it is, and in fact may even go higher if supply continue to be restricted. So I think eventually the supply demand dynamics is pretty much on the supply side for palm, because supply is just not there. Now, I would say one key or one important benefit of trading commodities is, commodities generally display seasonal trend. So just look at production for CPO, for example. If you notice for the past a decade or so, if you break down production month to month, One good thing about trading the Malaysia palm oil market is also good that we have a lot of data, and these data are all given by Malaysia Palm Oil Board on the 10th of every month. So just for example, I think today we have received the fundamental data from MPOB for the month of April. So with all this data, I think you can make more decisive conclusion as to where price may head. But if you just look at production data for MPOB and you break down into month-to-month basis, if you notice January around April, May, that's where the start of uptrend in production cycle. And that will bring you to at least until October. And at the end of October, normally at the start of November and December period, production tend to decline. So if you are trading the market, you should be very wary of shorting around the end of the year, because you are facing a lower production. Normally supply is tight because there's festive season, monsoon starts to come in, especially in East Coast and whatnot. Normally you hamper production. So that's where seasonality comes into play for the palm oil market. It shows a very clear trend for the production cycle as it is. Normally, up cycle will start around April and normally it ends around October. Now, if you just look at just today's numbers based on MPOB April numbers, it looks like production is still going up. But the problem is that the growth of production is slightly on the lower end. If this trend were to continue, I think likely, price will tend to be supported for at least a short-term basis. So, if you are trading the palm market, I think, looking at production pattern is very clear. That around the third and fourth quarter, production tend to be weaker, and that's where prices tend to be stronger. Now, if you compare the relationship between production and price, you can clearly see there is always inverse relationship. Whenever you have high production period, normally prices will tend to be softer, and when you have weaker production period, that's where prices tend to be supported. So if you just look at production numbers itself, really we saw a big change in the second half of last year. And that's where we start to see prices breaking out of its long range price term. Actually, in fact, I think it broke the 4,000 east once production started to decline rapidly. So I think all this production will have a big impact whenever you look into the palm oil price. Now, production aside, stocks are also important. Stock levels in a country is an important measure, because if you have a high stock scenario in the country, normally it tells you that pretty much the market is oversupply. Normally prices will find it difficult for it to go higher. But when you have situation where stock levels are low, that shows you that the price is going to go higher. So again, you look at if you break the stock levels month-to-month basis, you can notice that around May or June, that's where stock starts to increase, because reason being is because we start to see production picking up. Assuming demand is going to be stabilized, stocks will eventually be creeping up. But again, you look at it, production will start to decline around November, December, and that's where stock levels are also in line with production pattern. It will also start to decline. So that's where we really need to understand certain behaviors in the market at a certain period of time, especially when you're trading in the palm oil space. So yeah, this just to show you, I think if you're talking about other vegetable oil market, palm oil really currently is the answer to the world. I don't think soybean oil, rapeseed, and sunflower oil is sufficient enough to meet the world oil demand, vegetable oil demand. I think palm oil will have to come in to fulfill those demand. Now, talking about biodiesel, you look at it, I think crude oil and CPO has a very strong positive relationship, in the sense that whenever you have high crude oil price, normally you tend to see CPO prices tend to be supported. Reason means because whenever you have high CPO, whenever you have high crude oil price, normally the biofuel producers will be more incentivized to actually produce more biofuel, which means that they will demand more palm oil, and indirectly that will push up the palm oil price as well. So that's the relationship in terms of energy space. Obviously now we are in a very tight scenario. We are now contemplating whether should we be cutting the demand for biofuel, because the food demand for palm oil is just not enough to meet the supply. So indirectly, we really need to trim some of the biofuel demand and focus back on the food demand, because I think inflation is creeping up around the world. It's putting a lot of pressure in your food prices, and that's going to be a major issue. Now, if you are someone looking at the palm oil market, we always compare with soybean oil, which is like a brother and sister thing. You look at in terms of both their prices, there's always a spread that the market looks at between the soybean oil and palm oil spread. Now, naturally, soybean oil will trade at the premium compared to palm oil. Reason means because the cost of producing soybean oil is more expensive, and therefore it commands a bit more premium. Now, the natural premium in the market is about 150 US dollar per ton. Now, if it goes beyond that, that tells you that soybean oil is overpriced, and palm oil will have to adjust. Now, if it falls below the 150 premium, that tells you that the palm oil price is actually a bit overpriced. So I think there's a lot of instances. I think just second half of last year, for the first time we saw prices, the spread of both particular commodities went as high as 600 US dollar. We have not seen that for many years. And normally in that kind of extreme prices, it won't last. In fact, I think it took about 3 months from 600 US dollar. It actually reverted back to its average of 150 in a matter of 3 months, where you start to see soybean oil starts to come down and palm oil price starts to go up. So I think this is a very good, very good opportunity to sense where the respective market is going to be by looking at the spread between the palm oil price and the soybean oil price. So eventually, if you look at the spread going to zero, that means that palm oil price is actually a bit more expensive, and naturally you will see soybean oil a bit is compared, relatively speaking, is cheaper. So you can see both these commodity prices will start to adjust. It's a very good dynamics. If you are trading the palm oil market, do watch out. Do use this as a basis for you to understand how the movement of palm oil price against the soybean oil price. Now, the reason I put this chart, is because I just want to show you that over the past 2 decades or so, palm oil price in Malaysia has not been declining. In fact, if you just look at the average of the last 2 decades, the average of the CPU price has been moving higher and higher. Now, this is in line with the production cost as well. If you look at some of the Malaysian planters, they have been suffering higher costs. They are not only suffering higher labor costs, fertilizer costs is now a big problem. So eventually, I think year after year, production cost is going to edge higher and higher. So naturally, the floor as to where CPU price can fall to is going to get higher and higher. So right now, I think on average, cost of producing a ton of CPU is going to hit around 2,000 ringgit per ton or even higher. So that's where we probably will see the floor is. Eventually, when all these scenarios, supply demand dynamics start to be neutral, hopefully you start to see the market resume a bit more normality. So this is basically the price seasonality. So basically, you look at month to month, you break it down to their percentage basis. You notice that November, December is usually the strong month in CPO market. So if you are thinking to short at those periods, you better look at it in terms of historically speaking. Those are the period where prices tend to be strong. If you want to think of shorting the market, normally June, July, August is where prices tend to be a bit weak. These again are all in line with fundamental changes, especially with regards to production patterns, with regards to stock patterns or stock levels in the country. So that's on CPO in terms of some of the key factors that can affect the market. So moving into FKLI. Now, FKLI is more of an index futures contract, so technically it's more market driven, more economic events driven. So I think this year or so we have seen a lot of volatility in the market. Whatever happened in US market will have a bit of relevance in the Malaysian market as well. Just a couple of weeks, the last 2 weeks or so, we saw major decline in the US market. And last but not least, I think Malaysia also to some extent has feeling the impact as well. So these are some of the key factors that can affect the KLCI index market. Again, these are all quite economic factors that actually drive the market. These lists are not exhaustive. There's always other factors that can actually impact the KLCI index directly. But the main thing, I think, we have been, in the pandemic season for the past 2 years. I think, as with any other pandemics that's happening around the world, every time when there's a threat of a new variant, there's always going to rile up the economic aspect of the country. So right now, I think the major theme is inflation. And again, I think second thing is on the pandemic. Third thing, geopolitical tension is always something that's always very critical. We can never predict how geopolitics is going to behave. Certain countries can behave a bit more undecisively, and that will actually affect the whole geopolitical aspect around the world, and that will have tension for the domestic scene as well. Domestic politics, especially in regards to general election, I think all this is going to have an impact on the market. Again, if you are trading the market, you have to be very watchful. Whether you can use the historical as a relevance, or whether you can, as a trader, you tend to avoid these periods, especially when it comes to volatile periods like election, like geopolitical tension. You tend to wait for it out, patiently wait for it out until the market stabilizes, and that's where you probably could be positioning in the market. Malaysia is a oil-rich country. We export a lot of our oil products to other parts of the world. Obviously, oil price has a lot of relevance to the KLCI index. I think if you just look at today's performance on the KLCI index, just yesterday we saw massive down points in the US indices. But again, I think Malaysia has been very resilient and robust. This morning we opened lower, but we closed the day higher. So I think that shows that the resiliency of the KLCI market as a whole. I think being for the major fact that Malaysia is still pretty much quite an oil price driven country. Now, foreign capital is also an important criteria. If for index to climb higher, normally you will see that outflows will generally be inflows will generally be coming in, and if you see the index going out, going lower, generally that means that the foreign outflow is actually leaving the country. So foreign outflows are very important, and it does have an impact at the end of the day to the index. Now, I just want to share with you the price seasonality of the Malaysia index. If you just break down, at least for the past decade or so, and you break down to month, now generally the famous adage, they say that sell in May and go away. May, in a sense, it is still considered quite a weak month, but July and August is quite a volatile month for KLCI index. So technically, it means that if you are trading the market, you are heading into July, August, make sure you be prepared for higher risk exposure, because markets tend to be a bit more volatile during these periods. Now, December is a very unique period for the KLCI index. There's always the saying that December is always a window dressing period. It may, to a certain extent, show that kind of factor, but for the past 12 years or so, December always a strong month for KLCI index. So if I look at historical perspective, I wouldn't be shorting the KLCI index, especially when it's a strong period historically. So December is usually a strong period for KLCI. Now, relationship between the US market and the KLCI index is actually quite relevant. Now, it was quite relevant before 2018. But then after, I think, especially during the COVID season, where COVID struck us in the early part of 2020, the relationship between the US markets and the Malaysian market has actually diverged. The linkage has not been there. And I think that shows a lot of whether the US market is still very relevant or not. But then again, I think you can still use as a yardstick. If US market is overnight down by more than 1,000 points, normally you expect the KLCI market will react. The problem is the quantum of the reaction in Malaysia market is still quite minimal as compared to the overseas market. Because like I mentioned, I think the Malaysian market in general is quite resilient, given that the companies as represented by the index is quite robust in certain ways. Now, and again, oil price has been climbing, and that's been benefiting the Malaysian markets. A lot of foreign inflows are starting to come into the market, to be riding on the energy team. Again, because Malaysia as a whole is still an oil exporting country. So just to show you the impact of foreign inflow and outflow. So whenever you look at foreign inflow coming in, normally you expect the index to perform. And generally when foreign starts to move out of the country, normally you see the index tend to be weaker. Now, I'm also showing you this to show you the relationship between crude oil and the KLCI index. Generally, they are quite a positive relationship, in the sense that whenever you see a strong oil price, normally you see the index to be well supported. Now, this is quite a unique relationship in the sense that comparing between the ringgit performance against the KLCI index. Generally, when you have a weaker ringgit, normally the index will not be will not be that friendly, will not perform that well. So what you're seeing right now is that we are seeing a weaker ringgit in the sense that US dollar is strengthening against other basket of currencies. And generally, if you look at historical pattern, whenever you have a stronger ringgit, normally the index will not perform that well. So I think this relationship, whether it still holds, is remain much to be seen, because there's also other factors that can affect the KLCI index. But keep in mind, I think do watch out how the ringgit relationship is going to play out with regards to the KLCI index performance. So I'm just going to go briefly with the trading plan. Do bear with me if you are new to technical trading, if you are not new to the terms like moving averages, or even Japanese candlesticks or Heiken Ashi. Do bear with me. Although this is quite technical, I can't cover too much in depth in this session alone. But I just hope that you can grasp the basic principle that underlies the simple setup of this trading plan. So I think to create a trading plan, try to be as simple as possible, but not too simple. And again, it's not too sophisticated, because when you have too many signals, you can get a lot of conflicting signals, and you may miss an opportunity for you to enter and exit the market. So the first thing to create a trading plan is to first identify the trend. So if you're a trend trader, it's always important for you to identify what is the current trend of a particular market. You can do that using exponential moving average, which is one type of moving averages. And moving averages is basically taking the price and just divided it by a moving average. And in that sense, you will take a 200 period exponential moving average. It's actually a quite long period. It almost representing more than 8 to 9 months worth of trading dates. Once you have that, the common setup you can use is different periods of EMAs to use it as a way of determining whether it's a bullish or bearish crossovers. And that's where you'll be putting your entry and exit signals. Now, I'm not sure how many of you here are familiar with candlesticks. Now, I use candlesticks as a reference to Japanese candlesticks, but I use a bit more. It's a sort of like derivation of the Japanese candlesticks, which is called Heiken Ashi. And I will share on later on. Heiken Ashi is a bit more. It's slightly different compared to Japanese candlesticks in the sense that it portrays the trend in a clearer manner as compared to Japanese candlesticks. So if you're a trend trader, you want to see the trend in a clearer fashion, because when you see Japanese candlesticks, there's a lot of configuration. Later on, I'm just going to share you later slides the benefits of using Heiken Ashi. Last but not least, you have to manage your risk. Every trade that you enter, you must make sure you have a plan to exit. If you don't do that, especially when you have volatile markets like this, that's going to be very wild. Your P&L is going to be is going to suffer a very wild swing. So importantly, make sure you must have a risk management in place. And last but not least, trade review. I know it's always a hassle, especially you are someone new to the market, you're trading, just starting off trading. Every time, every day and night, after the session closes, you do a journaling. It's going to be a very difficult task, but it's important because it gives you insight as to where your ability to look at the market, or where you make a wrong decision at a certain point in time. So I just want to quickly go through some of the trading plan. First thing is that you can always use a 200 period EMA to determine the range that is in the market. So say for example, the FCPO market, if you plot it with a 200 period EMA, you start to notice that in the late part of 2020, prices have started to trade above the 200 period EMA. And that tells you when prices are trading above the 200 period EMA, it tells you the market is going to go higher, because generally the market is in an uptrend. And when you have prices trading below the 200 period EMA, generally that tells you the market is trading on a downtrend. Now, when the markets like this are on an uptrend basis, you will be thinking positions for you to enter a long position in the market, basically following the trend, rather than finding positions for you to be shorting the market. Because when you have an uptrend like this, and especially a strong uptrend like this, it's always a difficult business to find positions for you to short the market. Because eventually, the trend, you should be following the trend instead of against the trend. The business of trading against the trend is always a difficult proposition. So always take the least resistance path, which is try to use a trend following method rather than finding methods that's against a major trend. Now, FQR is slightly different. If you look at it, although prices are trading above the 200 period EMA, but the EMA period line is quite flat in the sense that it's telling you the market is actually heading sideways. Obviously, the range is quite wide. It's between the critical point of 1007 to 1005. But it has been trading that range for pretty much a couple of months now. So eventually, there will be a breakout, whether it's on the downside or the upside. So if you're a trend trader, normally you watch for that kind of opportunity, because normally after a period of consolidation in the market will generally be trending aggressively, whether it's on the downside or upside, once it breaks its support and resistance. So yeah, I'm just going to show you two exhibits here. So exhibit A and exhibit B. If I want to ask you which particular market will you, if you look at the chart wise, will you be looking to trade? Or in other words, which particular exhibit will show you a better or clearer trend? Is it exhibit A or exhibit B? Maybe some of you can type in the chat box and maybe I can get an answer. Yeah, I see some responses coming in. Yeah, so many of you have said that generally exhibit B shows you a better trend. Now, exhibit A is what we call Japanese candlesticks, your normal Japanese candlesticks. Exhibit B is what we call Heiken Ashi candles. Now, Heiken Ashi candles are a derivation of Japanese candlesticks. Basically, it's using the middle price of the Japanese candlesticks. So if you look at the differences between exhibit A and exhibit B, if you are a trend trader, if you're using Heiken Ashi, you'll be in the trend longer than if you're using Japanese candlesticks, because it does show you how the trend changes by looking at the colors of the bar. So once the color changes, that shows you the trends is going to be weak or going sideways. So these are the Heiken Ashi formula. I'm not going to go too deep on it. You can always Google it. There's a lot of materials on the internet that's talking about Heiken Ashi. If you are trading trend on a first time basis, just have a look at Heiken Ashi, because in a sense that it does filter out your normal Japanese candlesticks and it shows you clearly how the trend moves along the way. So just to share you a bit of Heiken Ashi dynamics, every time when you see red colored candle body bars, that tells you the market is on the downtrend. Vice versa, if you see long green candle bars, that tells you the market is on the uptrend. And when you see a series of red and green candles, and it's short body, normally that tells you the market is sideways. So if you're a trend trader in a sideways market, normally you will use a different type of trading style. But when you see a proper trend in play, you have to, it's evident from Heiken Ashi, that's where you'll be using Heiken Ashi as a way for you to enter a particular market when it's trending. So now, the reason I chose Heiken Ashi as compared to Japanese candlesticks is because Japanese candlesticks has a lot of derivation. You need to understand what's doji, three white soldiers, bullish harami, and whatnot. There's so many patterns that you really need to be accustomed with when you're trading Japanese candlesticks. When I use Heiken Ashi, there's only three major patterns they need to know. If you see a red colored body bar or green colored body bar with upper and lower wick, that tells you the strength of the market strength at that time is weakening. If you have wicks that on both ends, but if you are weak on one end and it's a full color body bar, that tells you the market trend is trending. And obviously, if you look at doji type of signals, that tells you that the market is actually going on a sideways market. So it's actually very clear. You want to see whether the market is trending on the current point in time, just look at the color body bars, whether it's having upper wick or lower wick, or just on a 1 week alone, and whether it's like a doji type of candles, because that's how you are eventually able to see the candles to depict the trend in clearer manner. So these are some of the benefits of using Heiken Ashi. I think these are all self-explanatory. I think the major thing is that Japanese candlesticks has a lot of combinations, but Heiken Ashi has just only three major forms, and you just need to understand the three major forms, and that's sufficient for you to be able to identify trend in the market. So I'm not going to go on the definition of moving averages. You can obviously read it on the internet as well. There's always different types of moving averages, and here I use exponential moving average, which gives you a bit more relevance on the current data. In a way, it reflects more of the prices, current prices as compared to the previous price. In other words, it actually reflects the movement much faster as compared to simple moving average. So if you are using crossovers, here I'm using a crossover. Basically, I'm using two periods of different periods in EMA. One is a shorter term, which is a 9-period EMA, and another one is a longer term, which is a 20-period EMA. So when you have bullish crossovers, that tells you that the shorter term, which is a 9-period EMA, is crossing above the longer term 20-period EMA. Vice versa, bearish crossovers are 9-period crossing below the 20-period EMA. That's bearish crossover. So this is a bearish crossover example. You can clearly see that the 9-period crossing below the 20-period EMA, that's usually signals that the market is going to be on a downtrend. Now, if you just going back to this slide, if you compare that with using Heiken SG and the crossovers, you can get quite a good signal to enter and exit the market. So in this example, if you have seen a bearish crossover on the EMAs, which is a bearish crossover, and if you couple with that with the red Heiken SG bars, that generally that tells you the market is going to go on a downtrend, and that will be a very good opportunity for you to be entering the short position in the market. Obviously, you have to do this on a backtest basis. Make sure before you actually set up on these plans, make sure you do a bit of backtesting on some of the results. Okay, last but not least, I think in terms of risk management, it's important for you to use. There's a lot of ways for you to manage your stop losses. Some people may use a fixed amount of stop loss. Say, for example, if I just want to lose 1% of my capital on a daily basis or on each trade, you can always use that. Whichever fits your risk preference or risk profile, and it does help. Just continue to use it. What I advocate in my trading plan is that I use ATR, which stands for average true range. It's a very good indicator in the sense that, especially when markets are very volatile. When markets are volatile, you tend to make sure that you have enough buffer to make sure that, you cover a bigger stop loss amount, because when markets are swinging very well, you don't want to put your stop loss too tight. Then you'll be getting out of the market very often. So one good way to make sure when markets are getting very volatile or changing volatility is to use ATR indicator. So ATR indicator is basically taking the true range, the high and low, and comparing the previous period. So a way for you to put a stop loss based on ATR value is putting a multiple. Say for example, the ATR value is 10 on an SCPO contract period. So if I want to use my stop loss as 2-to-1 ratio, it means that I will take a profit 2 times of ATR and only willing to risk 1 ATR. So that's how we use ATR as a multiple. So to put into context, you can see that ATR, historically speaking, for CPU has actually been highest in history right now. I think just early part of April or May, we saw the average volatility in CPU market as high as 400 per day. I think that's tremendous. We have not seen this in history. So indeed, we are in a very volatile period in the CPO market. So when you put your stop loss, you have to make sure that you have to accord this kind of volatility in part of your risk management plan. So ATR is one of the big tool for you to be using. So for example, I think if you enter a short period, there's a very good entry to short because there's a bearish crossovers are coming in. You have a red Heiken actually full body candle. It's a good entry to short at this level. And if the ATR value is 110, and if you work on a 2-to-1 reward to risk ratio, that means you're looking at 2 times of ATR as your profit level, and you only risk 1 time of 1 ATR as your risk level. So that's where you'll be putting a stop loss at 6,510 and your target profit at 6,180. That's how you calculate based on ATR value. So as long as ATR value changes, you'll be managing your stop loss based on the ATR value accordingly. So again, I think this is on FQI. The ATR value for FQI is slightly on the downside. That means the market journey is less volatile for FQI. Again, markets can get very volatile instantly. So having an ATR multiple to manage your stop loss is actually quite a good point when it comes to a very volatile phase in the market. Okay, so I think at the end of a trading plan, importantly for you to do a trade review, keeping a journal is important. Like monitoring a win-loss ratio, keep track of your volume that is incurring and commission that's incurred, and always make sure to keep your mental capital. Mental capital is far more important than your money capital, because mental capital is what gives you the strength to drive every day. If you are doing this for a full-time basis, if you are doing trading on a full-time basis, mental capital is much needed. You're doing this on day in, day out. If you don't have the mental strength, it's going to be very difficult for you to progress. Okay, so given the shortage of time, I'm just going to continue very briefly on options as well, since it's the second part that's being covered under derivatives market. To make it simple, I think options itself, especially to someone that's new to the derivative scene, can be quite complex, because there's a lot of terminology that you need to be aware of. But just going to keep it very simple. Now, just to show you an example of what a pizza voucher example. Assuming you are given a pizza voucher, or probably you need to buy, and the cost of buying this pizza voucher is 1 ringgit. Now, this pizza voucher will expire in the end of the month, and it's a 20 ringgit. This pizza voucher allows you to buy the pizza at 20 ringgit. It comes with a drink and side dishes. Now, obviously, this voucher will cost you 1 ringgit, and probably you purchase it. Now, when you purchase a pizza voucher like this, normally what it states that you have the right, but you don't have the obligation to buy the pizza and drinks for 20 ringgit until the end of the expiry. The way for you to use the voucher is, if the price of the pizza falls to 15 ringgit, for example, because whether nobody demands or whether supply is just too much, and the price of pizza falls, normally you will not use it, because you can technically buy cheaper without the coupon, and technically the coupon will be worthless. Now, if the price of pizza goes higher because the strong demand, supply is limited, and say, for example, the price goes up to 30 ringgit, now normally you definitely use the voucher, because the voucher allows you to buy the pizza at only 20 ringgit, and that saves you 10 ringgit. So that's how, in a certain ways, options is being functioned. It's very similar to this pizza voucher example. Whenever you have price that is above the exercise price, normally you will not use it, and that's again how options works, especially financial options works in real life. So there's always two types of options. One is a call option and one is put options. Call options provides the buyer with the right but not the obligation to purchase the underlying futures contract. Put options always again the right but not the obligation to sell a particular underlying, whether it's a futures contract or whether it's a particular commodities. So always remember, a call option gives you the right to buy. Put options gives you the right to sell, but not the obligation. So again, keeping back to the principle, buyer of call and put always have the rights, but not the obligation. Now, when it comes to the seller point of view, if you're selling put or options, normally it's an obligation. There's no right for you. Whenever the other party exercise a particular put or call that you're selling to, you have to oblige to pay whatever price that's being agreed upon. So as a seller, there's more risk. In fact, your risks are unlimited. But as a buyer, your risks are very limited by the amount of that you're putting in to purchase a particular options. So there's two types of expiry options. American options are very flexible in the sense that American options can be exercised at any time before the expiry. European options are a bit more restricted. You only can exercise on the expiry date itself. American options are not meant that options are only available in America. It's not the case. In fact, I think you look at Bursa Malaysia options are mainly on the European side, but what it means is just a different definition on the expiry, on the way it's expired. So some of the key features, obviously you must know, is that options has expiration date. It usually expired based on the futures contract. It has a strike price. Every options will have a different strike price that is available to trade. premium, that's always is basically the price of option that you pay. I'm not going to go too deep on open interest and option writer, but it goes to tell you you can also be a seller of a put and call. But again, being a seller of an option is always a higher risk, and you have to take note of the risk. So just to give you an example, these are all theoretical examples. Say, for example, this is 100 lots OKLI August contract for a strike price of 1,560, and the type of options is a call options for 1.40. Now, this 1.40 is not 1 ringgit 40 cents. 1.40, that means you have to multiply by the point value for this OKLI. OKLI, the derivation is always following the FKLI contract. So every 1 point is 50 ringgit. So the cost of this contract per lot basis is 70 ringgit. So this is how you quote options, and that's how if you're buying put and call, is a similar concept. Now, moneyness is something that is is so-called terminology in options market. So if you are looking to buy a call, so say for example the strike price is 1560. When the FKLI is trading at 1560, that normally means the strike price and the market price is the same. Now, if market price goes above 1580 and you purchase a call option for 1560, technically you're making money. If the market price fall below 1560, you won't be exercising the contract because your options only allows you to buy at 1560 and the market price falls below. Technically, you can just buy cheaper from the market. Put is basically the option for you to sell. So obviously, when market falls below, that's where you'll be making money, and when market falls above, we won't be exercising the contract. So again, I think moneyness is talking about in relation to the strike price against the exercise price or the market price. Basically, these are the diagram of the payoff. I'm not going to go too deep on this. Pretty much you can always refer to the payoff for call and payoff for put buyer is always very limited to the premium that you pay. So eventually, like the pizza coupon analogy, if you don't, you can ultimately, if you think that the price of pizza is not favorable to you, you can choose not to exercise the contract or the coupon itself. Ultimately, it's just waste for the 1 ringgit that you pay on the premium. So eventually, as a buyer of options, you are limited by the premium that you're paying. So put options, these are all signals. These are all the payoff diagrams. Again, I'm not going to go too deep. Now, one of the benefits of using options is because the potential profit is great, but the potential loss is limited. That's why options is attractive to a certain extent. So OKI and OCPO, they are all listed contracts on Bursa Malaysia. You can get this contract specification that's available on the website. You can go through it. Now, there's a lot of strategies that you can use. You can combine with certain strategies, sophisticated strategies like strangle, straddle, and whatnot, or you can just purely, just buy a call and buy a put and keep it simple. So I'm going to focus on benefits of options given the limited time that we have. First thing, I think options allows you to do hedging. If you're using futures market, you can obviously hedge using the options market as well. When it comes to leverage, options has bigger leverage as compared to futures market. Now, going back to the earlier example, leverage is a double-edged sword. So if you have higher leverage, that means it potentially exposes you to higher risk. It's also highly flexible. Again, you can do a lot of combination, especially when it comes to sideways market. Normally, traders will prefer to use options. And loss are always limited because if you're a buyer of a put and call, you are limited by the premium that you pay. So some drawbacks of options is that liquidity can be an issue, and time value is an important element that it makes a bit a difficult sense for new traders. Okay, I'm just going to end it here with one quote. Regardless whether futures or options market you are in, X Sakota is a very good trader. You can always Google him. I think he wrote 1 or 2 books. And this quote actually it speaks quite true to me, especially when during my early parts of journey as a trader. If you can't take a small loss, sooner or later you will definitely take the mother of all losses. So the keyword whether you are using futures market, your options market, or whether you are applicable in your general investing scenario, always make sure you take care of stop loss, take care of your losses, and your gains will take care by itself. So with that, I'm just going to hand it over to Saw for the Q&A, if any.
Now, because of time, before we begin our Q&A session, I would like to you to take just a minute of your time to fill out this feedback form, since we have already provided you an informative session today. So it just only take you less than 1 minute to fill out this feedback form. The link for the feedback form will be provided in the chat box. You can find it from there. So just take a quick 1 minute and let us know what are your thoughts, comments, as well as feedbacks, so that in the near future, we are able to improve further on our site and give you great value contents as well as learnings to help you improve your trade. So just take 1 minute of your time to fill up this feedback form, and then later on, we will be continue with the Q&A session. Okay, about time's up. If you have already submitted your feedback already, I appreciate that. Thanks a lot. While for those of you who haven't finished the feedback form yet, you can continue to finish it. And thanks for your participation in giving us your valuable feedback. And now we will be continuing with the Q&A session. So if you have any questions that you would like to ask David, do type in your questions in the Q&A box so that I am able to pick up from there. And also, due to time constraint and limitations, do know that we are unable to answer all of the questions. And I'll pick some of the most frequently asked questions so that all of you are able to, have to understand today's topic better. So I see there are some questions in my Q&A box here already. So one of the questions that our participant asked is that earlier, David, you mentioned about vegetable oils, right? So for trading FCPO, which other vegetable oils that we can actually check with?
Yeah, that's a good question. Thank you for the question. I think when it comes to other vegetable oil per se, as compared to CPO, I think one of the common market comparisons is always the soybean oil market. So if you just look at the spread that I showed earlier, we always look at the price differential between the soybean oil and the palm oil market when it comes to the vegetable oil market per se. So soybean oil is a very good comparison. There's obviously other vegetable oil like rapeseed, sunflower, but nothing beats soybean oil whenever you are talking about palm oil market.
Okay. Next question would be earlier you mentioned about the FKLI index, right? So one of our participants, I think he asked that why does Malaysia index does not really follow the international market indices?
Yeah, it's another good question. I get this a lot as well. Now, if you just look at the behavior of the KLCI market, in certain ways it is a bit diverging from where the world market move. Reason means because again the foreign participation is actually quite low. A lot of domestic institutions are in the market. So technically, I think the movement of the index is actually more heavily influenced by domestic movement. But again, foreign inflow does to a certain extent create impact, but it's not much as compared to the domestic move. So KLCI in some ways is very resilient when you look at it because as compared to other markets, it moves much less. but it's also mainly driven by the domestic move, which is heavily capitalized in the market right now.
Okay. And another question is, who are the brokers for KLCI and FCPO? I think this participant is relatively very new in the futures market. So who are the brokers for FKLI and FCPO?
Yeah, if you are referring to brokers as derivative brokers, Bursa, you just can head on to Bursa Malaysia website. There's a list of derivative brokers that's available. You can always go and check them out. You can always give them a call, and they'll be more than happy to answer any of your queries to start your journey in the futures market. So I mean, I won't name a few. You can always get the list from Bursa Malaysia with regards to the brokers for the derivatives market.
Okay, so for those of you who are new in futures market, and if you like to open a futures trading account, that's where you are able to find who are the brokers for futures brokers in Malaysia. So all you can do is go to Bursa Malaysia's website and find out who are those brokers. Okay, next questions. Who are the big players in the futures market?
Oh, okay. That's also a very good question. I won't term it as big players. There's obviously different segment of players in the market. Take for example, the palm oil market. Palm oil market, you look at futures market, who are the major players that need futures market? Obviously, it's those who are involved in the product itself. Basically, your planters, your millers, your refiners. That's one side of the market. Then obviously there's also other side of markets, pure speculators like probably you and me. We are probably speculating on where the price is going to go. So there's never one size that's too big or for the other. The market is actually quite vibrant. And again, Malaysia futures market is not only a domestic scene. We also have international players that's in the market. So it's very hard to say who are big players are. But by nature, the market works very vibrantly when you have a lot of participation from different various stakes holders in the market, be it whether you are a speculator, be it whether you are just using a futures market to hedge, because all these will create vibrancy in the market.
Okay, I think next question quite similar with the big player question. So can the futures market be manipulated by the big players? I think this is from a stock market perspective participant, right? So the question is, can the futures market be manipulated by the big players?
I only have one way to answer this question, and that way will be, if you just look at volume on the exchange itself, you talk about easily 30,000, 40,000 contracts on a benchmark basis for FCPO on daily basis. To have that kind of volume, you really need to have huge margin. Obviously, this can be single-handedly if you have someone that's big enough, sufficient capital. You can eventually may influence the market. But then again, market has a lot of other participants as well. And when you have high volume market, like what you are seeing in the past couple of months, it's very difficult, for a particular party to try to influence the market, because when you have heavy volume, heavy participation, it's very difficult for one-sided, to influence a certain decision in price.
Okay, because of time concern, I'm going to pick up a few more questions. One question is, will the future price goes against the underlying asset price, which means that the opposite direction?
Okay. Maybe I hope I can answer in whoever asked the question in one angle. If you are referring to the divergence between the futures price and say for example the cash price, let's take an example of the FKLI. If you are referring to the futures price in FKLI against the stock market KLCI index price, obviously there's a period of time where they diverge. And usually when you see divergence like this, and let's take for example right now when sentiments are bad, US market is dropping 1,000 points. Malaysia economy is facing high inflation. With this kind of bad negative sentiment, normally the futures market will be trading at a discount compared to the cash market, and that's the divergence. And no, it's not unsurprising to see such a move. But normally, if you are trading the market, you're trading the product, you tend to be a bit more sensitive when this happens. So in one way to answer the question, there's certain point in time where there's divergence happening between the cash market and the futures market. But eventually, if the market will mean revert or revert back to its original state when market starts to stabilize. So I think in a way to answer the question, it does diverge, but this kind of divergence won't last for a very long period.
Okay, one more last question. David, can you sum it up what are and highlight to us what are the advantages of futures market compared to stock market?
Yeah. So if you look at one of the slide I presented earlier on the key benefits of using futures contract, obviously I think one of the major benefit is that futures market allows you to capitalize on position where you're thinking to be shorting the market. If you have a view that maybe in next coming weeks or months where market is going to head for a severe downturn, if you are holding stocks, generally it's very difficult for you to either you can sell those stocks or take a profit or loss, and you can't do anything else. But futures market, it gives you the advantage where you can actually go on the opposite side. If you have a view that the market is going to head into bearish mode, you can always short the market. I think second thing is margins. Is highly leveraged. Now leverage is in a way very is very misleading. Obviously, leverage to a certain extent is benefits you, but then again, in many times it does also disadvantage you. But again, that's the key features of futures market because it trades with margin. It doesn't gives you don't have to come out the full value of the contract. You just have to place a fixed margin per contract basis. In certain ways, it gives you benefit. But I also want to highlight in certain ways it also does give you disadvantage if you don't manage it well. So I think these are the two major key attributes of the futures market as compared to the general stocks market.
Okay, thank you, David. So I think that's it for today. Allow me to wrap up this session for today. Now, as I've shared with all of you earlier in the beginning of the webinar, this is the LLF Futures webinar series. It is a series of topics where we will be conducting every Tuesday evening, same time from 8:30 to 10. And there are a lot of content and informative topics where you will be learning practical knowledge about futures trading. So if you'd like to join any sessions, you can scan this QR code and register the topics that you would like to attend. And from there, when you scan your QR code, you will be coming to our website and you can find on the Tuesday column to search the topics that you would like to participate. And one more thing is that for those of you who are really new in the futures market, or maybe you are futures market, but you are not quite familiar with the futures market yet. So if you want to understand futures market deeper and how to trade futures in details, so as David have already shared with you some of the few fundamentals in futures market, and you can see that there is a lot of things to learn, believe me in that. So in this online workshop, it's very different from the usual webinar. And in this online workshop, it's definitely right for you if you would really want to learn futures in details, because today's webinar just only briefly introduce you about the futures market. So if you're still very new in the futures market, or if you're thinking of trading futures, I highly recommend you to join this online workshop right now. And this online workshop is very different from the webinar because it is a step-by-step process where we will be guiding you how to kickstart to trade for your first futures contract. It is a detailed class from A to Z for beginners. So all you need to do is pick up your phone or take a screenshot of this particular slide and register yourself right after this webinar ends, okay? Because each and every session, we will be limited to the first 50 online attendees only. So remember to register yourself in all of these both workshops and book yourself a seat. So if you would need to join workshop one first before you proceed to workshop 2. So there will be two languages, English as well as Mandarin only. So remember to register the topics that you would like to attend right after today's webinar, okay? So the online workshop will be either on a Saturday or Sunday. You can find in our events calendar. And before we end this session, let me introduce you to this Brusa Academy, where this Brusa Academy is a comprehensive one-stop e-learning platform where you can get all of the informative as well as knowledge about stocks, futures, and any other products that you can trade in Bursa Malaysia. You can scan the QR code on your right here, or you can Google search Bursa Academy and make sure you are able to find this particular link here, and you can access to Bursa Academy for more information. All right, that's it. This comes to the end of our session today. Thank you, David, for sharing your insights and knowledge about Malaysia futures and options market. And I thank all of you for your participation tonight. And I believe you have learned a lot of informative knowledge and broadened your perspective about the derivative markets, especially on the futures market, and some strategies of how to trade the futures market. So with that, I'm CY. I wish you stay safe, stay healthy, and have a good rest. And I'll see you next time. Goodbye and good night. Bye.
Thank you. Take care.